A pleasant day to all. I am Margaret Blanche Brizo and I will discuss about the international flow of funds. It occurs when buying and selling of goods and services happens between the international market through the use of export and import from one country to another. The transactions of international business cause the flow of funds from one country to another and helps into money to flow from one to another market. With that, you will be obtain fundamental knowledge about the basic concepts about international flow and funds. Moreover, you will gain relevant knowledge on how it works to help the organization sustainably operating in the international market. Furthermore, after our presentation with Pansoy May Valerie, you will be able to explain the key concepts of balance of payments, explain how the international trade flow of are influenced by economic factors and other factors, and to identify the different advantages and disadvantages of international flow of funds. International business is facilitated by markets that allow for the flow of funds between countries. The transaction arising from international business cost money flows from one country to another. The balance of payments is a measure of international money flows and is discussed in this report. Financial managers of MNCs monitor the balance of payments so that they can determine how the flow of international transactions is changing over time. The balance of payments can indicate the volume of transactions between specific countries as well as potential changes in specific exchange rates. So when we say balance of payment, it refers to a summary of transactions between domestic and foreign residents for a specific country over a specified period of time. It represents an accounting for a country's international transactions for a period, usually a quarter or a year. It accounts for transactions by businesses, individuals, and the government. Within a given time frame, the balance of payments can be in a surplus or deficit. When the export transactions surplus the import transactions in a given time period, the surplus balance of payment is recognized. On the other hand, when the export transactions are less than the import transactions of one country in a given specific period of the time, it is sent as deficit balance of payment. Let us identify the different components of balance of payments. These are current account and capital account. Let us differentiate the two components by explaining each. So the first component is a current account. So it represents a summary of a flow of funds between one specified country and to all other countries due to the purchase of goods and services or the provision of income on financial assets. In the other definition, the short-term transactions of a country and the differences between the savings and the deposits aggregately constitutes the current account of the balance of payments. Current account transactions include export and import transactions of goods, export and import transactions of services, money transfers, and income from factors such as land and foreign shares. So let's discuss the different components of current account. So the first component is the payment for merchandise and service. So it will be represented through the balance of trade, which is the main component of the current account. The difference between the merchandise export and the merchandise import is the balance of trade. Take note that the country can export and import goods and services. Tangible products are commonly used to present merchandise export and imports. Some of the common examples are computers and clothing that are transported between countries. Service export and import are the intangible products such as legal insurance, and consulting services provided for customers based in other countries. For instance, service export by United States will be considered as an inflow of funds into the United States, which service imports will be considered as an outflow of the funds into them. Second component is the transfer payment. So it represents aid grants from gifts from one country to another countries. When the company purchases raw materials from one country, then they secure international payment. It also belongs to the transfer payments. This kind of business transaction also affect the current account of international company. So the last component of current account is the factor income payment. So it represents the income received by the investors on foreign investments in the financial assets. Consequently, the factor income received by the Filipino investors will reflect as an inflow of funds into the Philippines. Factor income paid by the Philippines will reflect as an outflow of funds from the Philippines. The second component of balance of payment is the capital account. It includes the value of financial assets transferred across country borders by people who move to a different country. It also includes the value of non-produced, non-financial assets that are transferred across country borders, such as patents and trademarks. And the sum of total inflow and outflow of capital that directly affect a nation's foreign assets and liabilities is aggregate constitutes a capital account. It includes all international trade transactions between one country or nation and other country or nation. The following items are also included in the capital account of the balance of payment, investments, and loans of foreign countries, banking and other forms of foreign capital, and any changes in the foreign reserves. Take note that all transactions that are relevant to the export serviced by one country result in the inflow of funds, and all transactions related to the import services are the reasons behind the outflow of funds. Let us take a look at the components of capital account. Remember that a component of capital account includes foreign investments and loans, banking and other forms of capital, as well as monetary movements or changes in the foreign exchange reserve. So the capital account flow reflects factors such as commercial borrowings, banking, investment, loans, and capital. Let us discuss the main components of capital accounts. A financial account is a component of a country's balance of payments that covers claims on liabilities unpaid to non-residents, physically financial assets. The financial account is a measurement of changes in international assets ownership. So the financial account has two main sub-accounts. The first is the domestic owner of foreign asset. It measures money flowing out of the country to purchase foreign assets. If this increases, it subtracts from the financial account. The second sub-account is foreign ownership of domestic assets. So it measures money flowing into the country to pay for the assets. If this increase, it adds to a country's financial account. The financial account components are similar in each sub-account. That only difference is whether the asset is owned by someone in the country or a foreigner. A domestic ownership of assets further divided into three types of ownership: private, government, and central bank reserves. No matter which entity owns the foreign assets, increases subtract from the financial account. Let us focus on the private ownership can be either individuals and businesses. Their assets include deposits and foreign banks, loans to foreigners, securities of foreign-owned companies. So direct investment made in foreign countries, commodities such as gold, held in other countries, foreign ownership of domestic assets. This sub-account is further divided into two types of ownership: private and foreign official assets. So when foreigners increase their ownership of a country's asset, it adds to the financial account. So these domestic assets include deposits owned by foreigners held at the country's bank, loaned by foreign banks to domestic banks, foreign private purchases of a country's government bonds, corporate securities such as stocks and bonds owned by foreigners, foreign direct investments such as reinvest earnings, entities and debt and other debt owned to foreigners, hard assets such as gold and other commodities, the other country's currencies. Foreign official assets include assets that are mentioned a while ago that are held by foreign governments or foreign central bank. Net shipment of a country's currency to foreign governments or foreign central banks. Take note that the financial accounts measures the change in international ownership of assets. This should not be focused on the income, such as interest and dividends, that is paid out on the assets owned, that is measured by the current account. Moving forward, financial account also composed of the following: direct foreign investment, portfolio investment, and other capital investment. When we say direct foreign investment, it represents the investment in fixed assets in foreign countries that can be used to conduct business operations. So example of direct foreign investment includes firms acquisition of a foreign company, its construction of new manufacturing plant, or its expansion of an existing plant in a foreign country. Second, portfolio investment. It represents transactions involving long-term financial accounts such as stocks and bonds between countries that do not affect the transfer of control. And the last is other capital investment. It represents transactions involving short-term financial assets such as money, market securities between countries.
So, hello, good day. My name is Valerie Pansoy, and let us move forward to the discussion of international trade flow. So, trade flow measures the balance of trade exports minus imports. This is the amount of goods that one country sells to the other countries minus the amount of goods that one country buys from the other countries. This is the calculations include all the international goods transactions and represents a country's trade balance. Next, the following are the influential factors affecting the trade flow. First, we have the impact of inflation. So if the inflation rate of a country increases as compared to the other countries with whom they trade, then the value of the current account will decrease after taking an assumption that all the other factors are constant. In this case, the country's exports will decrease because of the inflated prices, and the imports of the country will also increase as the local companies will also purchase products from the overseas market, where there is a low rate of inflation to minimize their purchasing costs. Next, we have impact of national income. If the gross domestic product of a country increase, then the per capita income of the people of a certain country will also increase, which leads to increased consumption and spending of countries. Moreover, this definitely increase the demand of imported goods and will give adverse effect on the balance payment of the country. Next, we have the impact of government policy. So the government policies of a country greatly affect the trade between two countries at an international level. The policy of a country either help them or restrict them. So to do import and export transactions with the other countries that can totally change the conditions of the balance of payments and balance trade, this also determine the growth pattern of one nation. This is one of the most relevant factors that affects and controls the flow of funds from one country to the other, which constitute the international trade and international flow of funds. Next, we have the subsidies for exporters. Subsidies provided for traders. The rate of subsidies decide the volume of exports in a country. If a country promotes exports in its country, then it tends to provide a lot of subsidies on international trade, and mainly on the export activities. For instance, like India, huge subsidies are provided on the exports of goods and services to any other countries. Another example is China, where they receive free loans and the free lands from the government for the production of goods and services that can be exported in the future. Take note that these subsidies are helpful for countries' exporters and importers to capture the larger share of the global market. Next, we have the restriction on imports. If the government of a country acts as substantial responsibilities on the import and related activities in their countries, then it will help the country to improve their balanced payment position, as the public will not able to purchase goods and products from the other countries. On the other hand, if the country impose less obligation on the imports, then people of the country will import more and more from the other countries and will adversely affect the payment of position of a country. Next, we have the restriction on the piracy. In some cases, a government can affect international trade flows by its lack of restriction in piracy. Next, we have the impact of exchange rate of foreign currency. So each country's currency is valued in terms of other currency through the use of exchange rate, so that the currency can be exchanged to facilitate international transactions. So if the foreign currency in which the export or import transaction takes place more fluctuates at a higher level, in that case, the balance of payment for that specific period will also fluctuate at a greater extent and somehow equal to extent of changes in the foreign currency in the international market. Next, let us move forward to the discussion of advantages and disadvantages of international flow funds. The identified advantages of international flow of funds are the following. First, we have the increased aggregate demand. The overall product demand will increase if the international flow of funds is allowed in a country. Before the implementation of globalization of all over the world, the demand for the local product were not so good and a lot of companies were experienced a huge organization failure. Then, when the implementation of trade flow was allowed, the demand for the local as well as international product began to increase, and most of the manufacturing companies emerged as big giant industries at that time. Next, we have the increased production capacity. After the globalization period, more countries industrialized as a manufacturing hub. The existing production capacity of the countries also rise as they now had buyers from their products in a huge quantity, which leads to increased profits. Thus, their production capacity subsequently increases as well. If in the case of flow of funds from one country to another is limited in the future, many of the manufacturing companies will be at the boundary of crisis and the economy of many countries will crash. Next, we have the technological advancement. If the import and export from one country to another is easy and promoted, the country also becomes technologically advanced. This is due to the new and innovative technology can easily float from one tree to another. On the other hand, if the import and export policy from one country to other is restricted, then the country becomes obsolete or outdated in terms of the technology and innovation. Next, we have the surplus on the financial account of the balance of payments. Capital inflows from any other country can help to finance the current account deficit. With the help of attracting capital flows from the international market, it enables one country to effectively import more goods and services. Without these capital inflows, a current account deficit would lead to a deflation in the exchange rate to restore stability in the balance of payments. Next, we have easy finance in the international market. The flow of funds is very easy and it assists the domestic companies and even government raise funds from outside the country, which is easier through the help of the flow of funds from outside the country or by means for foreign direct investment. Next, we have the inflow of foreign currencies. The international flow of funds help the country to get foreign currency easily as all the transaction of imports and export take place in the foreign currency only. So next, here are the disadvantages of international flow of funds. First, we have the loss to domestic players. Internationalizations of funds, that means the promotion of imports and exports transaction can destroy the market of domestic players. The domestic market gets affected when international player enters the domestic market given the fact that imported products and services are more advanced. Next, we have the tax evasion. International companies like Facebook and Amazon move to the countries that have lower tax foundations. The companies save their expenditure on corporate taxation by operating in the underdeveloped and developing countries where the tax on doing business and related activities is very less. Next, destroying the real estate market. The international flow of funds can also be in the way of purchase of assets or real estate property in the other country. Many multinational companies invest in their real estate property in the other countries, which helps them to restrain their profits in the form of investment in the other countries. Moreover, it helped them to reduce their tax liability on the profits. This sometimes increases the price of the real estate property in the domestic country as multinational corporations set up their plants in particular area. Next, money laundering. The problem of money laundering will possible when the funds are easily allowed to flow from one country to another country, which can also become the cause of many illegal criminal activities like terrorist attacks and emergence of black money in the banks of the other countries. Black money includes all the funds earned through illegal activity and otherwise legal income that is not recorded for tax purposes. Next, to facilitate the effective and efficient international flow of funds, the following agencies have the full support to the system. First, we have the International Monetary Fund, or IMF. The International Monetary Fund is an international organization headquartered in Washington, D.C., consisting of 189 countries working to foster global monetary cooperation, secure financial stability, facilitate international trade, promote high employment and sustainable economic growth, and reduce poverty around the world. Next, we have the World Bank Group. The World Bank is an international financial institution that provides loan to countries of world for the capital projects. It comprises two institutions, the International Bank for Reconstruction and Development, IBRD, and the International Development Association. Either the World Bank is a component of World Bank Group. The World Bank's most recent stated goal is to reduction of poverty. As of November 2018, the largest recipients of World Bank loans were India with 859 million in 2018 and China with 370 million through loans from international banks for reconstruction and development. Next, we have the World Trade Organization, or WTO. So World Trade Organization is an intergovernmental organization that is concerned with the regulation of trade international between nations. It is the largest international economic organization in the world. These are the organizations that facilitate the flow of funds from one country to another. and in the international markets, and also forms the rules and regulation for all countries in the world for doing international trade, international investment, and flowing of funds from one country to another. In the nutshell, international flow of funds consists of positive and negative effects, or the business operation of the company and to economy as whole. But if we're going to see in the larger context, the internationalization of funds more is money is required and is very necessary for expansion of the country. It is also important as it plays big role for making underdeveloped country and developed one. The international flow of funds assists the countries for making themselves technologically advanced and helps them to promote trade between them. This also helps the sellers to sell their products and services into international level to expand their local brands into international brands and to expand their business at an international market, which not only helps the company but also the society as they generate more employment opportunities and provide their better quality products to them. So overall, the international flow of funds is good most of the aspects for the development of countries and the world's economy. So that's all. Thank you and God bless.
So, good day, everyone. Good day, Miss. For the next topic is the international capital structure. So, the most crucial component of starting a business is capital. It acts as the foundation of the company. Debt and equity are the two primary types of capital sources for a business. Capital structure is defined as a combination of equity and debt that is put into use by a company in order to finance the overall operations and for its growth. A capital structure relates to how much money or capital is supporting a business, financing the assets, and funding its operations. It can also show a company acquisitions and capital expenditures that can influence on a business bottom line. Capital structure is an important term to understand, especially for those who want to advance their business careers and for financial analysts. And these are the two kinds of capital structures. First is a debt capital. Debt capital consists of borrowed money that is due back to the lender, commonly with the interest expense. For the senior debt, if a company faces financial trouble or filed for bankruptcy, financing under this category gets paid back first. Senior debt loans tend to have lower interest rate. Subordinated debt, these loans aren't as risk-free as senior debt loans, but their higher interest rates mean lenders can make their money back and then some. Third is the mezzanine debt, a subcategory of subordinated debt. Mezzanine debt tends to carry higher interest rates because of the reliance on both equity and debt for funding. Then hybrid financing, another form of debt that relies on both equity and debt that pays interest or dividends, offers fixed and floating returns and are bought and sold by brokers. For convertible debt, this debt that comes in the form of bonds can be converted to equity based on a predetermined amount decided by its debtor. Next is loans or credit cards. Countless companies have an origin story with a historical capital structure that includes financing from family members, max out of credit cards, or both. It may not be the easiest way to build company capital structure, which is why loans or small business funds be a less complicated option, although the application process may be more involved, requiring a business plan and an outline of expenses. Next is the long-term bonds. This debt is a small business dream come true because it only pays interest and principal doesn't have to be paid off for a long time. Next is short-term bonds or short-term commercial paper. These 24-hour loans can account of billions of dollars borrowed from the capital markets, often used by larger Fortune 500 companies to cover major operating costs. Next is the vendor financing. Companies may turn to this form of debt to cover any bills owed to vendors, selling of goods to build their business while satisfying financial partners. And last is the policyholder float. Insurance companies rely on this band of debt to cover costs as needed and sit in an account and earn interest until the debt needs to be repaid. So for equity capital consists of ownership rights in the company without the need to pay back any investment. First is the hybrid financing, a mix of equity and debt found in publicly traded companies when bought and sold by a brokerage firm. Convertible equity, hybrid financing that may be offered via convertible preferred shares can convert to common shares at a fixed rate. Preferred equity, financing based on a degree of ownership interest in a business or company, which has its pros and cons such as payouts before other stockholders but not including any voting rights. Common equity, another form of financing offering ownership interest, although ownership doesn't happen until after the business or company pays off its debts, which makes it a higher risk. Next is the contributed capital. So when a company receives an investment in exchange for stock, this is contributed capital. This is often what's offered to venture capitalists and other first round investors, such as angel investors. Shareholders may also fall under this category. And lastly is the retained earnings. Companies can also use their earnings from previous years to fund their businesses, fuel expansion, or assist with acquisitions. This kind of funding works well for larger businesses with brand recognition, as they don't have to work as hard to convince investors to support the business by buying stock. But green or startup business will need to show a higher return to entice those some investors. And why do different companies have different capital structure? Firms in different industries will use capital structure better suited to their type of business. Capital-intensive industries like auto manufacturing may utilize more debt, while labor-intensive or service-oriented firms like software companies may prioritize equity. Next is how do managers decide on capital structure? So assuming that a company has access to capital, they will want to minimize their cost of capital. This can be done using a weighted average cost of capital calculation. To calculate WACC, the manager or analyst will multiply the cost of each capital components by its proportional weight. Then, how do analysts and investors use capital structure? A company with too much debt can be seen as credit risk. Too much equity, however, could mean the company is underutilizing its growth opportunities or paying too much for its cost of capital. So, what defines a healthy blend of debt and equity varies depending on the industry the company operates in its stage of development and can vary over time due to external changes in interest rate and regulatory environment. And last, what measures do analysts and investors use to evaluate capital structure? To evaluate capital structure, in addition to the weighted average cost, several metrics can be used to estimate the suitability of company's capital structure. Leverage ratios are one of group metrics that are used, such as debt to equity ratio or debt ratio. So, so capital structure is vital firm as it determines the overall stability of a firm. Here are some that highlight the importance of capital structure. A firm having a sound capital structure has a higher chance of increasing the market price of the shares and securities that it possesses. It will lead to a higher valuation in the market. Next, a good capital structure ensures that the available funds are used effectively. It prevents over or undercapitalization. Third, it helps the company in increasing the profits in the form of higher returns to stakeholders. And fourth is a proper capital structure helps in maximizing shareholders' capital while minimizing the overall cost of the capital. And lastly, a good capital structure provides firms with a flexibility in increasing or decreasing the debt capital as per the situation. And to sum it up, a company stage in the life cycle, its cash flows, characteristics, and its ability to support debt largely dictate its capital structure since capital not sourced through borrowing must come from equity including retained earnings. Second, to maximize firm value, management should target the optimal capital structure that minimizes the company's weighted average cost of capital. And third, in practice, financing decisions are typically tied to investment spending and based on the company's ability to support a debt given the nature of its business and operating cash flows. And last, management's capital structure decisions impact various stakeholder groups differently. In seeking to maximize shareholders' wealth of their own, conflict of interest may arise in which one or more groups are favored at the expense of others. And that's all, Miss. Thank you, and may God bless us all.
So we have here the continuation on their introduction on the international capital structure. So many major firms throughout the world have begun to internationalize their capital structure by raising funds from foreign as well as domestic resources. So as a result, these corporations are becoming multinational not only in the scope of their business activities, but also in their capital structure. So by internationalizing its corporate ownership structure, a firm can generally increase its share price and lower its cost of capital. So this trend reflects on the ongoing liberalization and deregulation of international financial markets that make them accessible for many firms. So next is the importance of finding the right capital structure for a business. Every business has different needs, especially when it comes to capital structure. So the cash flow and financial support requirements for an international conglomerate are likely going to be more involved and complicated than that of a mom and pop shop. So a mom and pop shop is a curated full spectrum marketing network of high caliber talent built to work quickly and efficiently without the overhead of an agency. So similarly, the capitalization needs of a company focused on consumer goods, which may carry a lower risk, will vary in comparison to travel company where needs and demands and flow with the seasons, but both businesses still need to determine what kind of capital structure is going to help them to be successful and for them to be able to meet their goals. So next is how does capital structure work? So business leaders need to independently come up with a capital structure that works best for their operation. So any type of debt or equity is accounted for the capital structure. For instance, debt includes traditional business loans, but it also includes any supplier credit the business receives. So both debt and equity come with cost and these are known as the cost of capital. So this is a simple cost of capital is the interest rate paid on loan, but all forms of financing have their cost. Equity financing comes at the cost of some ownership stake in the businesses. So all in all, it's common to assess a company's capital structure using ratios like the debt to equity ratio because this allows analysts to quickly gauge how much the company's capital structure is made up of debt and how much is equity financing. So next is the recapitalizing. So during a business lifespan, it may choose to alter its capital structure. So this is known as recapitalizing. Just as forming an initial capital structure is an individual process in which recapitalizing can take many different forms. So a business can recapitalize by essentially exchanging debt for equity. So it can acquire more debt either by issuing corporate bonds or by taking on a business loan and then use that leverage to purchase back some of its equity in the form of a share buyback. So conversely, if a business feels like its debt is getting on out of hand, it might issue new stock. So the new stock issue will bring in cash in exchange for equity, and that cash can be used to pay off a loan or otherwise reduce the business debt. So next is we have here the following factors to determine capital structure. So we have here four. So first is the cost of capital. Second is the degree of control. Third is trading on equity. And lastly is the government policy. So starting on the cost of capital, it is the cost that is incurred in raising capital from different fund resources. So a firm or a business should generate sufficient revenue so that the cost of capital can be met and growth can be financed. So moving on to the degree of control. So the equity shareholders have more rights for a company than the preference shareholders or the debenture shareholders. So the capital structure of a firm will be determined by the type of shareholders and the limit of their voting rights. So next is the trading on equity, which is for a firm, it uses more equity as a source of finance to borrow new funds to increase returns. So in here, it is said to occur when the rate of return on total capital is more than the rate of interest paid on debentures or rate of interest on the new debt borrowed. Lastly is the government policies, which is the capital structure is also impacted by the rules and policies set by the government. So next is the key takeaways and the following information that I have been shared. So first is the capital structure. So it refers to the way that a business is financed, the mix of debt and equity that allows a business to keep the doors open and the shelves stocked. The next is a company's ideal capital structure will depend on its specific situation, including factors like the cost of capital, the business cycle, and any existing debt or equity. Lastly is when a company exchanges one or of financing for another, such as taking on debt to buy back stock shares. That is known as capitalization. So that's all for my reporting.
So, good day everyone, and I am here to report the cost of capital. So, what is a cost capital? So, a cost capital is a company of calculation of the minimum return that would be necessary in order to justify undertaking a capital budgeting project such as building a new factory. New factory. So the term cost of capital is used by analysts and investors, but it is always an evaluation of whether a projected decision can be justified by its cost. The investor may also use the terms to refer to an evaluation of an investment potential return in relation to its cost and risk. Many companies use a combination of debt and equity to finance business expansion. For such company, the overall cost of capital is derived from the weighted average cost of the capital sources. So this is known as the weighted average cost of capital. So it will be discussed later. So in understanding the cost of capital, the concept the concept of cost capital is key information used to determine a project hurdle rate. A company embarking on a major project must know how much money the project will have to generate in order to offset the cost of undertaking it and then continue to generate profit for the company. So the cost capital, from the perspective of an investor, is an assessment of the return that can be expected from the acquisition of stock shares or any other investment. So this is an estimate, might include best and worst case scenarios, and investors might look at the volatility, so the beta of a company financial result of determine whether the stock cost is justified by its potential return. So here the weighted average cost of capital, excuse me, a firm's cost of capital is typically calculated use, using the weighted average cost of a capital formula that consider the cost of both debt and equity capital. So each category of the firm's capital is weighted proportional, proportionately to arrive at a blended rate, and the formula considers every type of the debt and equity in the company balance sheet, including the common and preferred stock, bond, and other forms of debt. So next is the finding the cost of debt. So finding the cost of debt, um, the cost of capital becomes a factor in deciding which financing track to allow, so that equity or a combination of the two. So in the early stage, companies rarely have a sizable assets to pledge as a collateral of loan for loans, so equity financing becomes the default mode of funding. Less established companies with limited operating history will pay a higher cost for capital than older companies with solid track records, since lender and investor will demand a higher risk premium for the former. So the the cost of debt is merely the interest rate paid by the company on its debt. So however, since interest expense is tax deductible, the debt is calculated on an after-tax basis as follows. So here is the formula. The cost of debt is equal to interest um, over total debt times 1 minus t. So it means the I interest expense, it is a um, interest paid on the firm's current debt. So while the T is the company marginal tax rate. So the cost of debt can also be estimated by adding a credit um, spread to risk-free rate and multiplying the result by 1 minus T, the company marginal tax rate. So next is the finding the cost of equity. So finding the cost of equity, the cost of equity is more calculated since the rate of the return demanded by the equity investor is not as clearly defined as it is by lender. So the cost of equity is approximated by the capital asset pricing model as follows. So here, the formula is the CAPM, the cost of equity is equals to RF plus B, open and close parenthesis, RM minus RF. So the RF, it means the risk-free rate of return, while the RM, to market rate of return. So in beta is used in the CAMP M formula to estimate risk, and the formula would require a public company-owned stock beta. For private companies, a beta is estimated based on the average of beta among a group of similar public companies. So analysts may refine this beta by calculating it on an after-tax basis. The assumption is the private firm's beta will become the same as the industry average of beta. So the firm's overall cost of the capital is based on the weighted average of this cost. So like for example, here. So for example, consider an enterprise with a capital structure consisting of 70% equity and 30 debt, and its cost of equity is 10%, and the after-tax cost is debt is 7%. So therefore, it was the weighted the WACC would be 0.7 times 10% plus 0.3 times 7% is equals to 9.1. So this is the cost of capital that would be used to discount future cash flow from the potential project and other opportunities to estimate their net present value, so the NPV, and ability to generate the value. So the company strives to attain the optimal financing mix based on the cost of capital for the various funding sources. So that financing is more tax efficient than equity financing since interest expenses are the tax deductible and dividend on the common shares are paid with after-tax dollars. So however, too much debt can result in dangerously high leverage level, forcing the company to pay higher interest rate to offset the higher default risk. So that will be all, and it will be continued to rate the difference between cost of capital and discount rate. Thank you.
Hi, good day everyone. I'm about to discuss three different topics that was assigned to me. And first is finding the cost of equity. Second one is the difference between cost of capital and the discount rate. And the last thing is the importance of cost of capital. So there are two primary ways to calculate the cost of equity. So the dividend capitalization model takes dividends per share, so that's DPS, for the next year divided by the current market value or CMV of the stock and adds this number to the growth of rate of dividends or GRD. So wherein you will be having the formula of cost of equity equals DPS divided by CMV plus GRD. The dividend capitalization model is the traditional formula for calculating the cost of equity or COE. So the formula is COE or next year's dividend per share divided by current market value of stocks plus growth rate of dividends. So for example, ABC Incorporation will pay a dividend of $5 next year. So the current market value per share is $25. So the expected growth is the expected growth in dividends is only 8%, or if we'll turn it into 0.8. So COE is only 0.2 or $5 divided by $25. So that's the formula on how we come up with that 0.2 plus the 0.8 is equal to 0.28 or 28% COE of 25 times 0.28 equals $7. So this method calculates the cost of equity to the company when paying dividends to investors. So the problem is that companies don't always pay dividends. So now the next lesson would be the difference between cost of capital and the discount fees or the discount rates. So the cost of capital refers to the minimum rate of return needed from an investment to make it worthwhile, whereas the discount rate is rate used to discount the future cash flows from an investment to the present value to determine if an investment will be profitable. So in many businesses, the cost of capital is lower than the discount rate or the required rate of return. For example, so a company cost capital maybe 10%, but the finance department will pad that sum and use around 10.5% or 11% as the discount rate. So the last lesson that I'm about to discuss is the importance of the cost of capital. So the cost of capital aids businesses and investors in evaluating all investment opportunities. It does so by turning future cash flows into present value by keeping it discounted. So the cost of capital can also aid in making key company budget calls that use company financial sources as capital. So most businesses strive to grow and expand. There are many options that so some of these are, you can expand a factory and buy out a rival, build new bigger factory. So before the company decides on any of these options, it determines the cost of capital for each proposal project. So this indicates how long it will take for the project to repay, on what it costs and how much it will return in the future. So such as projections are always estimate. So of course, but the company must follow a reasonable methodology to choose between its opinions. So that would be all for my report. Thank you so much.